to worry about it a lot, but I summarize it so you understand it. We have changing dynamics of specialness, which means there's so many. It's in the 80s in Australia, for example, and even in this country, we used to have only commercial banks. And then deregulation happens, where allow everybody to receive deposits under different names. Now, so many financial institutions come to the picture, which means they receive money. If you are DI, which means depository institution, you are, in Australia, they don't call it a bank, they call it DIs. DIs is a financial institutions who is allowed to receive deposits from the public. And if you fall under that category, then in this case, you have to be regulated under the financial institutions. Same happening also in this country. But what are those institutions? You will find banks, as you can see here. I can show you, still banks is the largest, but banks was the only ones. We have banks, as you can see, and the banks is actually 57.9 of the total assets. Now we have building societies also. Building societies is very, very less. And if you talk about credit union, all those were actually formed in the 90s, 80s, I think from here, see? And started to, but still very small as a total assets in the economy. And we have the other financial finance companies, money market corporations, but as you can see, and life insurance companies, but as you can see, life insurance, this is the superannuation funds. Superannuation funds actually means the retirement funds. In this country, they call it EPF, if you have heard about it. So this is actually controlling 20%. And if you talk about life insurance, 24. So between EPF, insurance companies, and banks, we are talking about around 90%, 96%. So 20 plus 24. So we are talking about 94 actually with the banks. The rest, you know, are taking 2%, 1%, whatever, less than 1%. That's all. This is the total financial assets. So as you can see, we're still dominated by these three institutions: the banks, the life insurance, and superannuation funds, which is the pension funds money. But you have to be to understand what is the building society and credit union. Actually, I brought for you here one definition and links. Building societies is a financial organization which pays interest on investments by its members and lend capital for the purchase of or improvement of houses. This is what building societies have. We have so many. If you go to the link, this link, you will see so many building societies. And if you go to the, in Malaysia, we have only one. Actually, it becomes a bank. Building societies in Malaysia, we actually Malaysia Building Society Berhad, which is MBSP, SB, which is, this is the link of it. Credit union is the same thing. It's a type of financial cooperative that provides traditional banking services, ranging size from small, volunteer, but this is built actually by corporations. So it's built by corporations, controlled by corporations to help the members who are employees in the corporations. Here you have to be a member of the building society to receive those ones. Now, either credit union or building societies, they are receiving money. They are receiving, you know, some type of deposit from their customers or members, and therefore they become DIs. See, this is the issue. So coming back here, you can look at all those issues. You know, this is the financial institutions, but maybe I said maybe building societies and credit union is not very clear to my students, so I wanted to add that slide. Okay. In terms of the services, if you look, this is 1950, huh? This is actually 1950. And this is a very interesting data. You are not responsible, of course, about those trends, but I give you example. This is 1950. and this is 2012. See the services, we have payment service, saving products, and then the lending for business, consumer, equity, and this is the operations in the market. Now, depository institutions, specifically banks, were doing up to here. They were doing the payment system, receiving deposits and giving loans. And they don't really operate in the market. Financing companies were doing here. Now, securities firms and superannuation funds were only receiving saving, which is they receive only the money of and this is a long time ago. Now, everybody is doing all those services. As you can see, banks already, they do that, but look for the insurance companies. They do payment, they receive deposits, they give loans, and they invest also in the market. They do all those functions. Finance companies do the same. So actually, there is now a trend where everybody actually is, banks is still the biggest, but where everybody actually is still operating, and the business models and their functions are improving over time. This is just to tell you about it. But still, as I told you, if you are talking about how much the total assets, most of the total assets still with if you look at the balance sheet, you will see most of the money, where all this money goes. Actually, most of the money goes for the loans, as you can see, residential loans, and then business loans. This is where they invest those. This is all the financial institution, and where is the biggest bulk of investment. So they receive, if we talk about the asset, most of the money goes to the housing loans, and then it goes to the commercial loans and other assets, which is actually investments in the market. Where do they receive their money? 60% of it is from deposits. Now they can receive a little bit from here and here, like non-residential resident liabilities, this is deposits from outside the country. This is deposits from inside the country. And then you can receive some other things like bill acceptance, money market products, whatever, bonds, whatever. But actually, most of the money coming under the intermediation. So this is what I want you to actually to be aware of. Not really aware of, but you see how this how is the balance sheet is constructed. I am actually done with the most important issues here. There is only one thing, which is the regulations, which I promised you to talk about it. See, the regulations is very important for those institutions, which is the financial institutions. And when I say very important, what do you mean by very important? Regulators are really concerned. And then actually, as we will explain later on, if you don't comply with the rules, then you can shut down the bank. As easy as this. They can restructure the management, which means they can take the whole management, throw it away, and bring people from Bank Niagara or Reserve Bank of Australia, and then they can take over the management. Because this is no joke. You cannot tolerate any misuse of funds or any risk, because that risk will not go to the shareholders, but actually will extend and will have that ripple effect and will damage the whole economy and increase what we call the systematic risk, and not locally. What we said in the global financial crisis, it was just Lehman Brothers who collapsed. Somebody would say, okay, let Lehman Brothers shareholders get impacted, and let the bank collapse. No. Lehman Brothers collapse, other banks collapse, the whole economy collapse, and then you go and it just spread everywhere. It's a ripple effect. This financial system in the world, or even locally or regionally, is very fragile, which means you have to be very careful about every single issue. Regulators come here. regulators come to the picture. Even when we talk today about fintech, and we talk about Bitcoin, we talk about all these things, regulators are the biggest block in letting these things go or move because they are worried. Bitcoin today, allowed, tomorrow, deregulated. Allowed in China, then 2017, they didn't allow it. So you will have some regulators. You will have some countries who would allow, and then some countries will not allow. I mean, when we talk now about financial technologies, even those platforms, you cannot, startups, the P2P, the crowdfunding, very, very, strict. And when we come to the banks, the regulators, the banks, which is the, traditional institutions, the regulation is even harder, actually. So to come back to my point is, we talked about this. We say they provide the service, which is institutional based, and they provide this, which is general areas, which is the macro ones, and this is what they do for the economy, which we call it the institutional specific. But what if they don't do it? The question is here. What if they don't do it? What would happen? Let's see what would happen in the next slide. We will have negative externalities, and I want you to understand this term, negative externalities. Negative externalities means the damage will be towards other sectors of the economy and other parties. It's, as I told you, Lehman Brothers, when collapse, it should be the shareholders, and it should be the bank, or at least the American economy, or the banking system in the US. No, everybody was impacted because this integration and between the systems and the economic sectors have led to this issue. So you will find somebody who has savings, a pension savings, pensions, a pension in Europe during the financial crisis, and Netherlands and Sweden and Denmark. Those municipalities' money were lost in the US because they were investing there, or they are investing their money in banks, that banks are connected to the American banks. So it can do negative externalities. It can lead to market failure. But the regulators itself, market failure has been the systematic risk, which means it can damage everything. There is, when we talk about the regulations, there is what we call net regulatory burden. And what is the net regulatory burden? Net regulatory burden means, see, if you are a private financial institutions, and they tell you today you want to operate in Malaysia, they will tell you, okay, you operate, but out of each dollar you receive as a deposit, 4% of that, or 4 cents, has to go as a reserve in the central bank. You have to have a capital of 10.5%. You have to have a liquidity of around 5% over your current requirements of liquidity, which means for unexpected liquidities. You have, and then when we say liquidity, which means money stand there. It can be idle money. You cannot use it. You cannot invest it in long term. It will give you 0 return or no return. It's like cash. And when you give loans, you have to bring those loans like there is too much control in the exposure, which means the quantity of loans and how big they are. So if you look at all these regulations, it's actually impacting. And financial institutions say there is actually a net regulatory burden, which means when we apply those, the benefits, the private benefits from the private losses is the private what we call cost of those regulations is higher than the private benefit, as for me as a bank. But that's fine. Institutions, the regulators say, we understand that, but that's fine. They say it mitigates our this is what the financial institutions say, too much regulations is actually decreasing our efficiency and actually increasing our cost. But this is one of the things that financial institutions have to do, and this is what we call it net regulatory burden. So coming back, what are the packages of regulations? We have safety and sound regulations. This is one category. Monetary policy regulations, credit allocation regulation, consumer protection, investor protection, and entry and chartering. Let's go over them very fast. So when we talk about safety, this is the most important one actually. You have to have a first layer of protection, which means you have to have encouragement of institutions to diversify their assets. They have to have good portfolio, so they don't go to price risk or they don't go to liquidity risk. They have to control those, portfolios, either for liabilities or assets. Disclosure of large credit exposure. When you have, for example, in Australia, if you give any loan over 10% of your capital, you have to report it to EPRA, which is the regulators in Australia. In this country, almost the same. So no big loans. Don't risk it with someone alone, either business or associates or whatever. So no big exposures. Second layer of protection is capital requirements. You have to have 10%. So if there is losses, this capital will absorb the losses. And you have to have a third layer of protection, which is safety valve, like liquidity and deposit insurance. So deposit insurance, they introduced it after the financial crisis. Every country now have to be under this insurance. So if any bank collapse, you have to pay around every single saver has a right to receive up to 250,000 his money up to receive his money back up to 250,000. This is what the insurance. So insurance will cover up to 250,000. So I have 10,000, they will give me that 10,000. And if I continue with this up to 250,000, the insurance will be there. So this is also decrease the bank run, decrease the panic, decrease all those things. And fourth layer of protection is the monitoring and surveillance, which means this continuous and frequent reporting and monitoring by the regulators. So this is the first layer, the first category. Second category is monetary policy, and we have talked about it. So the money supply, you have to comply with that. And this is actually, sometimes the banks don't want to do that, but have to do it. And we have talked about the monetary policy. And the third one is the credit allocation. We already talked about it. They will force you to give some loans for some sectors of the economy. Also, this factor will give you a return of 5% or 4%, or maybe they are risky. You have to give it for the sake of the economy. And this is also a burden to the financial institutions, but you have to do it. And the third one is the Consumer and Investor Protection Regulations. In this country, we have Consumer Protections Act 2011, but in Australia, we have a responsibility of what you call Australian Securities and Investment Commission. This is actually the security. They have so many, codes and so many regulations to protect the investors and the consumers. There's an act in 2001. You have to comply also with the electronic funds in terms of the security of it. National private principles, which you have to, all of those, as you can see, code of bank practice, it's actually protecting your identity, information, or protecting your money, or protecting your relationship with the bank. We have also the entry regulations. Entry regulations is nice because they will not allow anybody to go to the business. So in this country, for example, if you want to go, you have to pay 1 billion ringgit to start a bank in Malaysia, according to the Commercial Banking Act 2013. And then not everybody can do that, 1 billion ringgit. And then you have to have the capital, and you have to have, you know, all those regulations. So there is this strong regulation inside, and also the entry is not easy. They will not allow anybody to enter. And if somebody is not fit, they will kick him out. So the entry regulations is actually preventing, it's not like a monopoly. It could be like a monopoly, but it's not like a monopoly. Regulators do that to control who is actually fit to operate in this business, and this is coming through the entry regulations. For example, in Australia, you can go, you can come as a foreign bank, but you are only allowed to receive deposit over 250,000. Somebody wants to deposit 5,000, they will not go to your bank. And therefore, you are not allowed to receive these deposits. And therefore, they will allow the local banks actually to operate better than the, this is some of the entry regulations to operate better than the foreign banks. So just to summarize, we said this is the services, the general services, and the specific services of the specialness. What if they don't do? We will have this negative externalities, market failure, and net regulatory burden is part of these issues. And this is the package. We have 6 packages. We have safety, credit. This is just a summary of what I just talked. It looks like it's nice to look at it like this, and you know, to map your mind for all those issues. And this is actually finally the regulators. We have 3 of them, Australian Prudential Regulation. This is like Bank Negara in Malaysia. This is actually like Bank Negara. If you want to look at it, this is like Bank Negara. Bank Negara Malaysia, or any central bank, if you are Australian, Central Bank of Australia, whatever. And this is the protection, as I told you. And this is the Reserve Bank of Australia, which is the father of all those, established in 1959. And all of those 3 is actually a council. They have a council here, which is actually the 3 regulators, they can be together. So actually 1 is to control banking, 1 to protect the customer, and 1 to take care of the monetary policy. And all of those regulators actually are in a team together under the Council of Financial Regulators. Thank you very much. I'm done here, and I will see you in the next video, and see you also in class. Thank you, and I will end now this session. Bye-bye.